Hello and welcome. In the world of taxes, there's one little word that can change absolutely everything: residency. It's a fundamental concept, but believe me, it's very often misunderstood. So today, we are going to tackle Canadian tax residency head on.
So, what exactly makes you a resident of Canada for tax purposes? It's not as simple as where you happen to be standing at any given moment. The real answer lies in something the government calls residential ties. And by the time we're done here, you're going to have a really clear picture of how they all work.
All right, so here's our game plan. First, we're going to start with why this is so important: the whole global income rule. Then, we'll break down the official test the government uses, looking at what they call primary and secondary ties. And finally, we'll pull it all together and see it in action with a really practical case study. Okay, first things first. Why are we even talking about this? Why is your residency status so incredibly important? Well, it all comes down to a massive difference in how you're taxed. And this right here is the fundamental divide. If you're a Canadian resident, Canada taxes your worldwide income. I mean, everything: the salary you earn in Canada, any investments you have in Europe, maybe a rental property over in Asia, all of it. But if you're a non-resident, you only pay tax on income you earn from Canadian sources. The difference, as you can probably imagine, is just huge.
So that naturally brings up the big question, right? If the stakes are this high, how does the government actually decide? It's definitely not just about your citizenship. They have a very specific framework they use.
And that framework is built entirely around this core concept: residential ties. This is the main thing the Canada Revenue Agency, or the CRA, looks at when they're trying to figure out if someone living abroad is still a resident for tax purposes. So what are residential ties? Well, to put it simply, they're these significant connections you still have with Canada. I like to think of them as the roots that keep you connected to the country, financially, socially, and personally, even when you aren't physically here. Now, here's a key detail. The CRA does not see all ties as being equal. Not at all. Some carry way more weight than others. So let's start with the ones they call primary ties. These are the most significant connections of all. There are 3 of them, and they are the big ones: having a dwelling place in Canada, having a spouse or common law partner here, and having dependents here. Now, this is super important. Unless you sever all of these major ties when you leave, you'll almost always be considered a resident of Canada, which means you'll be taxed on your worldwide income. Let's break that first one down. A dwelling place. This could be a house you own or even just an apartment you rent. It's a very strong indicator of residency. But, and this is a really important but, there is a key exception. If you leave Canada and you rent out your old home to what's called an arm's length party, basically someone you're not related to, the CRA might not view it as a primary tie anymore. The other 2 primary ties are pretty straightforward, but they are incredibly powerful. If your spouse, your common law partner, or your minor kids stay in Canada while you're working abroad, you will almost certainly be considered a resident. The classic example is this: you get a great job offer in the United States and you move, but your family stays behind in your Canadian home. Well, as far as the taxman is concerned, you haven't really left. Okay, so we've covered the big 3 primary ties. But what happens if those are kind of unclear? Or what if you actually have severed all of them? Well, that's when the CRA starts digging a little deeper and looking at what are called secondary ties to build a bigger picture of your connections to Canada. Now, secondary ties are broader and they're less significant one by one, but they really add up when you look at them together. You've got things like personal property, cars, furniture left behind. You've got social ties, like a membership in a Canadian club. Then there are the economic ties, things like Canadian bank accounts, credit cards, and even other things like a provincial driver's license or keeping a professional membership active. And this quote right here, this gets to the absolute heart of it. This is pulled directly from the CRA's own rulebook, and it's the key principle for secondary ties. They have to be looked at collectively. So just having a Canadian passport by itself or one bank account left open, that's probably not going to be enough. It's the total weight of all these smaller connections combined that really matters. All right, theory is great, but let's see how this all plays out in the real world. We're going to use a case study to apply all these principles to a situation and see how the CRA would most likely look at things. So let's meet Simon. He's taken a permanent job over in Ireland. His wife and his kids moved with him, and they packed up and took all their personal stuff. But here's the twist. He couldn't sell his house because the market was terrible, so he decided to rent it out. And for his career, he kept his CPA Ontario membership active. So the big question is Simon still a Canadian resident for tax purposes?
Let's break this down using our framework. First up, the primary family ties. Well, his wife and children are with him in Ireland, so those ties are clearly severed. Done. Now, what about the house? He still owns it, but the key fact is that he rented it out because of a bad market. That makes a very strong argument that this primary tie is also severed. So that just leaves the secondary ties. And in this case, only one remains, his CPA membership.
So what's the final verdict? Well, because Simon successfully severed all of his primary residential ties and only a single secondary tie is left, he would almost certainly be considered a non-resident of Canada. Just remember that CRA rule. It's highly unusual for one secondary tie to be enough to make you a resident. Simon's built a very, very strong case. And that brings us to a final thought, and it's really a question for you. Thinking about your own situation, if you were to pack up and move abroad tomorrow, which of these ties would be the toughest for you to cut? Would it be your home, your family connections, your professional life? As we've just seen, the answer to that question can have some pretty major financial consequences.